Hello and welcome to the Baby Giants Investing Podcast. Join us as we chat about the weird and wild world of small cap investing, all while searching for the precious few fast-growing businesses that have a shot at becoming industry giants.
This podcast is for entertainment purposes only and should not be relied upon as the basis for investment decisions. Podcast guests and their clients may maintain positions in the securities discussed in this podcast.
All right, we're back. I'm back in Australia too now, not as jet-lagged and sleep-deprived as I was for last week's one, so hopefully making a bit more sense. We'll kick off with some good news. I'll give a bit of a rundown as well of what happened in San Francisco. Maybe we can talk through some of Druckenmiller's latest stuff, debt ceiling, some companies that might benefit from inflation, lots of good stuff to go through. A few bits of good news that came through over the last week. Let me see. Waymo doubles the service area for Phoenix and continues growing in San Francisco. So this is self-driving taxis. I'll give you a bit of a personal experience of that very soon. Australia's homicide rate is down 50% from the 1990s. It's pretty good. Don't know if that's normally the tech kind of thing, that angle that we go for, but that came through. Some other techie stuff. Lab-grown meat is getting a key ingredient, 3D fat, which I guess makes it taste a lot more delicious than it was before.
The fat is where the flavor is.
Fat's where the flavor is. Yeah, 100%. There you go.
Embrace the fat.
An AI tool can predict pancreatic cancer up to 3 years in advance. Doctors have performed brain surgery on a fetus in one of the first operations of its kind. A lot of cool stuff going on, but it's kind of the same stuff. A lot of cool stuff going on with AI. A lot of cool stuff going on with like the nexus between AI and medical care. Yeah, so maybe I'll jump into the self-driving taxi thing. So,
before we do, so the good news is that the CDC in America has given guidelines about air ventilation and how many changes of air certain enclosed spaces should have. So I think that's obviously not going to mean that it actually lowers the sickness burden in the population immediately, but it gives people something to aim for. And after the pandemic 100 years ago, what you saw was then buildings start having really good ventilation. And if we do the same thing now, then that's actually could make a real difference to start reversing some of the bad trends we've seen recently, such as lowered life expectancy.
Nice. Well, that actually segues. I wasn't going to mention this one, but US death rate falls as COVID slips to the fourth most common cause of death. So maybe some good news related to that finally starting to go into the rearview mirror a little bit.
I guess my take on it would be too, you can sort of have a discussion of this without even talking about COVID. Imagine if just this was something with better ventilation, for example, was to reduce cross-infection in workplaces just for the common cold. How much does that save in like productivity hours and stuff? Like, there's a very solid economic sort of case for it to be made, just in general sort of sickness. And then obviously with potential of COVID, it's even better. But it seems like one of those things that just has long and lasting payoffs, and it's surprising it's not done more often.
Yeah, I think we still haven't adapted enough to what happened with COVID, in the sense that there's reasonable case that it was a lab created disease, right? Like there's different agencies, like different people have different conclusions, but it's not very clear that it wasn't, right? Like, and so then the idea is like we've now on this, like Sam Altman talked about that in his Sohn conference thing recently. We've just had the first global pandemic from like a man-made disease, or at least enhanced. And now we've got these new tools which will significantly lower the bar so that we can create a lot more of them. At the same time, those same tools could solve the problem. Sorry, Claude.
Oh, no, all good. Just wanted to dive into that a little bit. Do we actually know that it's man-created? Like, obviously it seems to be very likely it came out of a lab, but does that actually mean it's man-created? Couldn't they just have been studying it in the lab?
Yeah, that's true. I think... Yeah, I mean, even then, it's not even. There's still debate whether it came out from that lab as well, I guess. So yeah, that's true.
If we're waiting for China to admit that it came out of the lab, we're going to be waiting a really long time.
Yeah, I think that's a good point. It may not be that enhanced. It could just be from studying. But I guess his point was like we've had it created by us, not just a natural vector. If it was coming from a lab, but yeah, that's a fair point.
Yeah, okay. Like we're always got to pretend that it wasn't coming from the lab because it's like banned to say that. But but
it might not have been. I just want to interject. Like,
coincidentally came from the animal market next to the lab.
All I'm saying is that
I feel like we're getting down. Yeah.
I just definitive.
Okay, but I feel like we should have we needed to at least acknowledge that rabbit hole though, right? Like,
Oh, it's potential. I think it's kind of beside the point. It's sort of like I think that the potential for it to happen, and the lower bar for it to happen is something that we should definitely be.
Yeah, that's what Sam was getting at there. So that's more the point I want to get at. I think those are both very worthy things to investigate further. But his point was just the bar has been lowered for human creation of all viruses, basically. Like some of the AI research, I'm sure we've heard talked about, where an algorithm like created thousands of new prospects for diseases worse than smallpox, etc. At the same time, we've got like radically better solutions like mRNA vaccines, being able to sequence things so fast. I think that's probably where I'm surprised there hasn't been more. If you consider the trillions of dollars spent on direct COVID relief, there I think should be a very urgent effort to just the next pandemic, how fast can we respond to it and have like constant, like they talked about, it was Patrick Collison and Sam Altman, so two pretty smart people, just saying like we should just be doing more constant monitoring. We should be doing like having these, vaccine manufacturing facilities set up regularly everywhere.
I was just going to say, we have all kinds of people surveying the sky for asteroids, right? Now, we've never been hit by a massive asteroid, right? But it's a good idea. I'm really happy that money is spent looking for those kinds of existential. When you've got, it might be a fat tail event, it might be an edge case, but when the result of that is a zero, I'm never gonna. Of all the money that's wasted by governments, I don't think I'd ever complain about that kind of stuff. It's kind of like, oh yeah, but look, we've never been hit by an asteroid, so we should just stop looking at the sky just in case. Like, well, that's dumb, right? Like it's the payoff. Anyway, yeah, I agree. I agree with all.
I think also there's huge upside if you just somehow streamlined the approval of vaccines from mRNA now, because they can make them so quickly. They could just get the latest variant.
We had the mRNA vaccine ready in January 2020.
Yeah, exactly. So think of all like there's literally millions of people that died who would not have died if they'd just approved it. Why not just do a safety test? Now we know they work. Just do a safety test to make sure we're not like, like, I mean, a normal, proper science safety test, not like, an idiot town. I've already.
My uncle said on Facebook it was good.
Yeah. Do a proper scientific safety test. And then once you've done that, just like roll it out. Like, I'd do it.
Yeah, a lot of stuff we can do. So hopefully start doing some of that. But yeah, the segue for the Waymo stuff was I got to go in a self-driving taxi, which I think I sent you guys a brief video of in San Francisco, which is one of my.
So talk us through all of that, right? So you download the app. It's like ordering an Uber, right?
Yeah, I had to use a friend's one because it was really hard to do it as a tourist. Like you had to have a US domiciled phone and card and stuff. So I thankfully had a friend in San Francisco who could take me. And it was only after 10 p.m. So this is Cruise. It's like a competitor to Google's Waymo, I think related to or partly owned by GM, General Motors. But anyway, yeah, so 10 p.m.
Is that because of the traffic?
I think it is. Yeah, I think they want less traffic. I've heard some of their sensors might work even better at night. But yeah, I think it's just easier, basically. Less people out as well, pedestrians. So yeah, basically at 10 p.m. you push a button just like you're calling an Uber and a car appears with no driver. And the front two seats are both sectioned off. So I think that'll change, but it's basically just like a normal car with a perspex screen separating the front and the back. So kind of like you're going in a cop car or something, I guess, and you're put in the back and you can't like put your hand through and grab the steering wheel or do something stupid. You have to buckle up your seatbelt, three of us across the back seat. It's kind of stopped there. It's like giving you instructions on screens on the back of the thing. And yeah, it's just like, buckle up and we'll get going. And yeah, it slowly pulls out and starts driving. And it's like a very weird experience to begin with, particularly. And yeah, you can just see it moving along like its course. It doesn't show you as much of what it sees, like as a Tesla. I also had a bit of a trip in like a Tesla Model 3 while I was over in the States, and that you might have seen those videos of like modeling all the environment around you. It's not showing you that stuff as a passenger. Maybe, I don't know, in case Tesla gets it wrong sometimes, maybe it's not reassuring to realize what the model's getting wrong. And it was much cheaper. That could just be their initial pricing because they're trying to get usage, but it was like $12 for a 20-minute drive, so much cheaper than an Uber. Yeah, I'd say it's probably slower. Like it's everything they're leaning on as being like cautious.
Of course.
Particularly around pedestrian crossings. Like it just came to a pedestrian and was like very gradually kind of worked its way forward. But yeah, other than that, it worked. Like it could read stop signs, traffic lights, everything. So yeah, it's kind of mind blowing.
It's a tech that's kind of been forgotten, or it's gone out of the mainstream narrative. I remember when it first started coming along, and I know I do. I just jump on any sort of technology trend. Oh, it's the future. It's going to have, it's crazy. And then we're very impatient, as a species. I was like, well, I don't have my self-driving car yet. It turns out that was just a fad. And like, no, people have been building, and here it is, like proof. It strikes me that this is, like a lot of techs, this is now firmly in the, we've got this. This is just a process now of refinement, optimization, and adoption. And it's sort of like it feels impossible to me that this isn't a trend that just gets stronger and stronger and stronger and stronger.
Yeah, I'd say you'd probably use, like, I would use that over something else. But like if it was cheaper, which it should be, I think it would work. And yeah, to your point, I went to the Computer Science History Museum in Silicon Valley a couple of days later, and they had one of the Waymo, or one of the Google cars from 2014, and showing like, this is what we think the future of taxis will be like. And it was
had
like
a thing on the top, right? Like a LiDAR.
It did, yeah. And it was like, there was no steering wheel and stuff. It was like a passenger thing. But that's like 9 years ago, and it shows just that last bit of progress, how much work's been going into getting it across the line, partly because we're very cautious around it, but yeah, it's happening now. And one other thing from that computer science museum that weirded me out, which I guess I'd seen on the internet before but not in person, was having a like avatar robot person drive by who was, I think, doing a tour or was like visiting the museum. So those like screens on wheels,
yeah.
where they like drive home like, oh, hello, and they're like, oh, hi. I'm like, oh,
wow.
thought you were a robot and it's like a person. Do I just go and look at you? Like, it feels quite weird. So yeah, that was some of my futuristic moments. But yeah, that's kind of what I wanted to see in San Francisco. There's a lot of, it's like the idea like the future's here, it's just not yet evenly distributed. Like there's just a lot of things people take for granted in Silicon Valley and San Francisco that take a while before they get to us. So
do you remember the self-driving car in the original Total Recall movie? And it had like that weird mannequin driver.
Oh yeah.
Like
it so seems much worse.
Isn't it like some visions of the future? It's like, well, you got the self-driving part right, but why did we put this like satanic death doll in the cockpit?
I feel like Total Recall is like the absolute sweet spot for like exposing the different in our ages.
Do you watch the rebooted version, Claude? Is that
no, like, so whatever. I was like, a very small, too young for watching it when it came out, but I suspect Andrew was like, roughly at the perfect age or something.
Oh, I loved it. Frankly, I'll admit, I love me a bit of Arnie, right? Like I'll go there any day.
That was where he went to Mars, right? Is that the one I'm thinking about?
Get your ass to Mars. Great movie, nice. Classic. Check it out.
Yeah, so I think I was like way too young to have like somehow seen a picture of a woman with 3 breasts. Am I remembering that correctly?
Yes, you are. I almost mentioned that. But, yeah.
And I could see it as soon as I mentioned it. I could see you thinking about it.
It really like just that's the only thing I remember, and like obviously I somehow must have turned it on. I don't know how I saw that, but I was like, what?
That sticks in the brain. That image.
Yeah, I would have been way too young.
Was it like, what's the line? I'm gonna get this wrong, but it was like, baby, you make me wish I had 3 hands or something like that. Classic,
yeah.
Classic. Completely off topic. I'm sorry.
Excellent.
Sorry for that diversion.
Yeah, I don't know how to segue that to Druckenmiller. Yeah, so some of the other stuff that was going on while I was in the States, I think, was Druckenmiller's couple of speeches that he gave, which I thought were pretty interesting. So one was at the SOAN conference, the same one Sam Altman chatted at, and he also talked to, I think it was USC, but basically going to a college presentation. So Druckenmiller, as we've covered before, legendary macro trader investor, has an incredible track record over a long time and basically tries to predict macro events. And so basically one of the hardest things that you can do as an investor or trader. And so, and he changes his mind very frequently. So very different, like kind of a good way to think of him as like the complete opposite of Warren Buffett. Like Warren Buffett wants the stock market to be closed for 10 years. He wouldn't care. Druck wants to be able to change his mind literally when he like leaves a meeting. And there's many famous examples where he's been long something, argued with someone, and then the person's like thinks that they're right because the stock goes down, and later on Druck says, actually, I left that meeting and sold it short. Like he just immediately pivots.
He
which I
cops a
think
bit
is-
of grief for that.
yeah.
And I just think it's like a wonderful advantage that he has. Like, why, if the facts or your reasoning change your bloody mind, right? Like, good on him. I love it.
I agree. Yeah, I think it's something that I think we could all learn a bit more from.
Hell yeah.
That's my favorite way to invest is to have a short-term portfolio. It's like just not compatible with writing about stocks all the time. But in periods when I haven't been, my trading bill goes up massively. But there are lots of short-term opportunities that exist.
Did you know, as one of the things, a small point that stood out, he said that he's puts a lot of the trading decisions towards 20 and 30-year-old analysts because you sort of need that young.
Oh yeah,
macho-
I heard something like.
Yeah, like so it's sort of like he's sort of recognizing that I'm as I'm getting older, I'm becoming more conservative and hesitant. And this is a game where you've just got to go hard and back yourself. So it's sort of like they'll sort of have these discussions or whatever, but I need the 20-year-old to sort of go in there and just do it, right? And he's like irresponsibly long on a position kind of thing. But that's how he plays it. And I thought that was interesting. I find now that you've pointed out my declining age, I definitely feel as though I'm getting more conservative on things. So I thought, anyway,
You are not getting more conservative.
I am, man. I'm feeling more doubt and everything with things. I'm not as as a younger man, I would probably recklessly slow. I just pull the trigger on stuff without having well thought it through. But now I get a bit stuck. Like, do I? Should I? Maybe I'll just do nothing for a little bit.
You're eternally young, mate.
He is definitely
you.
looking at you on the video screen, looking very young.
He ages gracefully.
The filter.
Yeah, so I think that point's important. Didn't come up in this interview, but it's something else I read, like people covering the difference between Druck and Buffett, because obviously looking at both recently, was Soros only had 30% of his trades were winners. Only 30%, which we've often talked about how you only need 60% for the type of game we play, but only 30% were winners for him. It just showed he's basically trying to play this like asymmetric, not losing too much on all the losers and then having a few that win really big. And it's kind of what Druck was doing. But anyway, the interesting...
can I just double down on that? I think that is so super important, particularly as a small cap podcast and a lot of the approaches we take. I think that is, I look at my portfolio today, I'm pretty confident. I don't know which companies, obviously, but I'd be surprised. I'd be surprised if 50% don't turn out to be really ordinary, at least. But it can still make sense, right? Because the upside can be so significant on the ones that you get right. So it's worth making that point. I think too many investors cop too much grief. It's like, oh, you said that this was a great stock and it was. I'm like, yeah, by the way, that's going to happen a lot. And to your earlier point, maybe I've changed my mind on that as well. That this is all normal. And I think too often it's sort of seen as a failure, and it's like, what else do you expect, right?
Mm-hmm.
Anyway,
I think that ultimately, though, like you'd be crazy not to have some long-term positions as an everyday, investor, because basically it's an easier way to get good results if you find a good company and hold on, and it basically, the leaders keep on leading kind of things, the flowers keep growing. That's probably the easiest way to win. Whereas obviously what Druck does, like that's very high pressure. You have to act like it's like a treadmill, right?
Yeah, you have to keep turning over stuff more frequently versus a few good ideas. I get what you're saying.
And doing nothing when you don't is, I think, an underrated skill as well. To sit on the sidelines with a pile of cash is super hard, particularly when markets are ripping.
The worst thing I'm finding about sitting on the sidelines with a pile of cash is that, people still judge you on and you judge yourself. I judge myself on the money I have at work as well. But there's actually, the overall positioning is there's a pile of cash there waiting for better opportunities, but just, inevitable. Like, I don't want to be 100% out of the market because I never know, I could never know when the bottom would be. So I wouldn't want to be 100% out at any time, but it still feels like even if you're actually positioned correctly because you're not seeing the opportunities you love, it still feels pretty painful. I think that the reality is it's just you have more fun as investors when they're doing the zero interest rates free money ramp thing. Mm-hmm. And now is the winter of our investment lives, and you just have to be ready for the next silly bubble they blow.
Yeah, Druck's pretty excited about that. I guess his style, he likes the choppiness of markets. So he's I think largely he's being very cautious, not sitting on cash the way that he structures things, or some of it is, but just not very leveraged, basically preparing for some of the turmoil he thinks coming, and just sees a big opportunity to be really active.
Tell us about the turmoil.
Yeah, well, basically, he's been saying this since last year, right? Like last year is like, this is where it potentially something really bad, as in like a very bad recession, but he was predicting a recession, and he was saying like by the end of 2023, and this was like early or mid last year. And he stuck to it. In fact, he's even brought it forward slightly, which I thought was interesting that he's not holding off, because obviously the recession hasn't arrived as some people were thinking it would have done, US recession. So he's got kind of like a few different backdrops. One is that inflation is up. We've also got kind of a lot of the cycle just kind of like coming to an end, basically. Like a lot of the, you could say that COVID kind of forestalled a lot of it. And I guess coupled with that is his concern about how many asset bubbles have been blown. He talked about Dogecoin in a speech getting to an $80 billion market cap, which was just basically a joke.
Madness.
And yeah, just that it was multiple asset bubbles at the same time, and that typically after those asset bubbles, we have a bad period, basically. It's like not too much more complicated than that. And the other big thing he's talking about is US debt, kind of putting a cap on it. So that's what he says he's been talking for over 10 years about the 2025 onward period, just due to US debt. And the core reason is what you call entitlements, which is basically retirement payments, Social Security, Medicare payments to baby boomers, basically, that they'll be retiring en masse, and that this hasn't been accounted for.
So isn't the way out that they do that is they basically just run high inflation and don't increase the entitlements?
The entitlements currently are set to automatically increase with inflation. So that's one of the big problems. Yeah.
Wow.
So he talked about one example. I can't remember which one, a cola, which was like a 9% increase or something automatically. So that's one of the things they need to tackle. And how, when he basically did this big speaking tour back in like 2015 to all the college campuses, trying to get young people fired up about the fact that they were the ones that would get screwed, basically, because they wouldn't have any of these social benefits that the baby boomer generation get, because the US would kind of bankrupt itself before that happened. Like they're not able to sustain it.
But it is interesting how our generation has accepted getting screwed. Like in Australia, the most painful bubble for us is the property bubble. Election before last, when it was Shorten versus Morrison, like Shorten had a deflate the property bubble kind of, policy with a negative gearing removal, and people didn't vote for it. Like he didn't win. And that's the biggest single thing.
Was that young people's votes, or were they not as much? I don't know.
Oh, I guess young people always skew left, but you would be, it's surprising. But then Labor's dropped it. So there's no party that doesn't want to have a property bubble now. And, I think last party I was, joking about it, and I hope nobody took me seriously then. It's like actually a devastating thing, right? So it's just interesting. I'm just surprised at the millennial generation. I just think young people don't
think, particularly when it comes to retirement stuff, people just don't think they'll ever be old. Like you talk to a 20-year-old about retirement, and it's like, we live in a skewed bubble of people who save and think about retirement, but like it's a very skewed bubble. Yeah, it's so abstract to people. And they might just have a general idea like, I probably won't get it, but like don't even think about what that really means. And I think that's why he failed in his like appeal to it, because you talk to a bunch of college people, probably everyone also thinks they're going to be super rich, right? So everyone's like, doesn't matter for me. Like everyone thinks they're the exception, especially when they've got 40, 50 years to go. But yeah, so that's the math that he talked about. And the math he talks about in that USC one is just the Congressional Budget Office's projections. It's not like he's come up with something weird. It's literally just the basics of the model.
Well, that was the point I was going to make is that, it's not his own information. He's just, it's publicly disclosed from the source itself. And it's just maths, right? Dalio's made the same argument, right? And a bunch of people have. It's just, hey, we're spending a lot more than what we're taking in, and it's structural. And the things that need to be done are so, to your point, Claude, on property here, but it is political suicide for any leader of any stripe to say, we're not going to pay these entitlements, which is why it's such a rock and a hard place kind of scenario, and why the US will absolutely default on its debt, not in a hard way, but they will default by borrowing more, and it'll be a soft default.
Oh, that's not defaulting though.
I would argue it's very much. If the company you own shares in issued 20% more shares and you didn't get any of that, are you not being defaulted on in some way, shape, or form? I would say so. It's a very pernicious.
I guess you're being diluted.
Solution.
Yeah. But it's the same. In effect, it's the
same.
I
get what you're saying.
I am not.
It's not a good thing.
In nominal units, I'm being paid back, but I am not being paid back in my purchasing power.
What you're saying is that they can't pay it back, but it is. But that works out poor. But inflation's the only thing that shifts, not in a very fair or I don't know, whatever. Yes. Inflation's the only thing that shifts some of that power to the younger generations.
No,
right?
No, I disagree.
Are you sure though?
No, inflation is horribly. It widens the wealth divide, because what you will find is people of means have a lot of their money in things like property, high quality equities, these kinds of things. I don't necessarily think they'll be a great investment, but over long periods of time, they probably will preserve purchasing power. Something we should probably click into a little bit more. So if I'm a young person and I don't have assets and I'm earning this money that's being inflated away, like I'm the one who suffers as a consequence of the added dilution, where the others, if you basically want to have really high quality scarce assets in an inflationary environment, the nominal value will go up. You probably won't go up as nearly as much in terms of real actual purchasing power, but your wealth is preserved, and that's why it exaggerates the wealth divide.
So you're right, Andrew. According to the Journal of Economic Dynamics and Control, I don't know if that's a reputable
a fast Google
journal or not.
That's a good
Yeah,
Google.
I don't know.
I wasn't aware of them, but they sound like smart people.
It says surprisingly, basically, an increase in inflation results in an even more unequal distribution of wealth.
It's the lesson of history.
One more quick point that he makes is basically his demographics is the cause of this. You could blame other things like profligate spending, blah, blah, but the real cause is demographics. So the social security model was built in a time when the average woman had 3+ kids, say 3-point-something kids. And so you would always have this growing population that could support any retirees. And that was the whole premise of the model. And that obviously has changed dramatically over our time, where the average family is having like less than 2 children, below replacement. And that's, I think, going to cause that's the root cause of this problem that he's referring to. And that's why the math becomes really hard to resolve in any other way.
Do you think that's interesting to dive into, Matt? Because I'm pretty sure you and I have slightly different ideas about population growth, and I'm just keen to hear your take.
Yeah, I think that basically there was an idea in the 60s that population growth is bad because we have a fixed level of resources. And I think that is incorrect because it looks at humans as just being a stomach and not a brain. And basically with the combination of freedom and population growth, we actually outproduce the resource constraints that we have. And the reason is that resources aren't fixed in a knowledge economy because the value of a resource to us is what we can do with it. So sand, is not very useful. You can do so much with it, but to us, sand is silicon, which you can make the most advanced chips down to atoms, which means that our resources, a better way to think of it is like, it's closer to infinite with enough knowledge, basically, because it's how many ways can you rearrange the atoms that we have. And I like the analogy of like a piano, like how many songs can a piano play? And the answer is an infinite number of songs, because there's an infinite number of ways that this fixed number of keys can be rearranged. And so I think that's been borne out by some of the doomer stuff. This is why I often rail against the doomer narrative that we're going to run out of. There's going to be mass starvation, like that Ehrlich guy that I talked about before. I think you need freedom. You need like a few other ingredients that we thankfully have in a lot of the world. And I think that's the problem. And I think that's part of what China's going to face, basically, as the Chinese Communist Party got very convinced by this doomer narrative and kind of missed that they've had this incredible abundant growth from giving a bit more freedom to people over the last 20, 30 years.
It's interesting. I think the core of our difference is you have more of a faith that the freedom remains than I do.
Yeah, I think so. I think we still have a lot of free enterprise, but yeah, maybe.
We do now, but I just see it going in the wrong direction.
That's a good point, man. I think that is one of the challenges to the optimistic view. Is if we stop that, basically, then that's the other lever.
Something happened in public discourse in probably our generations almost. It went from we really did enter this Orwellian era where the people that shout the loudest about freedom actually are the ones that want to control how other people have sex or what pronouns they use, or all of this like micromanaging of other people's lives that basically just falls into a big who cares bucket if it doesn't affect you. And that, and then the next step is,
I get what you're saying. I think it's on both
sides.
You're
the wrong color, you're the wrong this, you're the wrong that, and it's the opposite of freedom.
I think I agree, but my view would be that it's literally both extremes. So being able to control, like cancel culture is also an example of censorship of thoughts. And that's on the other extreme, right? Typically.
Exactly. And this ties exactly into, Matt, why I feel like the millennials have missed a trick and that we really are in trouble in that our generation as a whole will have a worse quality of life than our parents, is because where you see the political activism for millennials seems to be in a lot of identity politics stuff, which is not very useful at lifting up your standard of living.
I'd agree with that. I'm still retain my optimism that we're in a tough period and that's going to start reversing. But yeah, I agree with all the trends that you're identifying there. I think that's a core problem. And I think that's
people like I want a right to a house to raise a family in. That I think a big issue with people having fewer children is just the nightmare in housing them, these days.
Yeah, I think that's part of it. As you talked about, maybe the housing problems, all the problems. Yeah, it's a
Anyway,
very deep topics.
Onwards, you shall be right. We shall flourish and somehow overcome.
Yeah,
I think what's an interesting angle with all of this is because it is really it's being talked about a lot. US recession, the debt ceiling, prolonged periods of inflation. The conversation naturally turns, I think, for investors like, okay, what do I do about it? I'm keen on your guys' thoughts here. I know that gold is sort of having a bit of a renaissance at the moment. There's a lot of activity, takeover activity in that kind of space. People talk about, I've caught myself doing this, where you say, well, what you want is a company with a strong balance sheet, reliable cash flows and pricing power, et cetera, et cetera. So yeah, I've had some reflections on that more recently, but I'm keen to see like, what do you guys do about it? Like practically?
Yeah, it's funny, man. I was watching the USC presentation, like I listened to that one on the plane, and it's like, he's like making a very dire case, right? And then
He's
at
talking
the end
about Druck, everybody.
Yeah, Druckenmiller, sorry. And then at the end, the first question is like, oh, okay, so you're saying buy gold, like, what's the trade? Like, it's kind of like, no, guys, the point of this presentation is like, we need to stop this disaster. And I think that's kind of like, but at the same time, we are investors. So like, we need to come back to that. What is the trade? I think for me, it probably reinforces that financial repression idea that we've talked about a bunch. Like I see that probably being the path forward, which
just
is
define us for that again. Just define that.
It's basically having inflation run higher than interest rates. So having say interest rates are like 4%, inflation at 5%, and nominal GDP growth at 6%. So you have real GDP growth of about 1%, but you like the repression part is that you keep interest rates pinned lower than inflation for like a long period. So you basically slowly inflate and slowly grow your way out of the debt problem. That's kind of the core view. And that's kind of what a lot of countries did after World War II with the debt problem. They used a lot of things that are foreign to us over the last our investing lives, but they kept capital under control and didn't let you move capital to other countries, didn't let you invest into certain things. They like a lot more government involvement in picking industries where they want capital to go.
China are already doing this to the extreme.
Yeah, China's whole growth model is financial repression. That's like basically they just repressed consumers and poured all of that into investment capex, which is why they've had such a boom and why they have the most unbalanced capex weighted economy ever. And maybe they'll keep navigating. We'll see. Like they've kept the party going like a really long time with that model. But yeah, that's the argument for financial repression as the path forward.
It seems to me like it's obviously not a desirable scenario, but on balance of probability is just the most likely, just the least bad, perhaps most politically palatable outcome, because it's very invisible. Like it's not going to be very apparent to a lot of people, and it just like again, it's just maths, right? Got to solve this equation somehow, and that just seems like the way that it's going to go to me. I'm 100% on Druck's side.
Okay, well, shall we do some small cap stocks?
I thought you were going to interject with something, Claude.
I wanted to. Here's an interesting observation, and I'll lay it out, and I'll give you my explanation for it. I look at a company like Woolworths, and to me, this seems very inflationary proof. It seems very recession proof. Very strong balance sheet, very reliable cash flows, massive pricing power. Inflation's good for these guys, right? Like they're just going to pass on the prices, and nominally they'll be making more. So it just seems like a really no-brainer kind of investment if you've got a lot of doom and gloom. But at the same time, and by the way, I love the business, right? I think it's going to be around for 20 years. It's a very disruption-proof business as well.
An Andrew-approved giant.
It is, and it kind of, but for 5 years I've been saying I wouldn't touch it, right? Because
if they started accepting Bitcoin, you would just be like,
they're so forward thinking.
Don't lure me there, Claude. Don't lure me there. But here's my point. So I think even optimistically, you'd be struggling to sort of rationalize consistent growth of sort of 5% plus per share earnings growth over any reasonable period of time. The current forward PE ratio for Woolies is 28, and the yield is 2.6%. Now that just seems like
high, man. Yeah.
And this is in an environment where multiples are collapsing and interest rates are going up. And so it made no sense to me. My only explanation is that people go, yeah, that's true. But I'm investing in this. I'm putting capital here, not because I'm trying to sort of get a 10% average compound return over the long term with dividends and everything. I just want to preserve my wealth. And it's probably not going to be a great return, but in 10 years' time, if I put 100 grand into Woolies, whatever that 100 grand purchasing power is today, I'll probably more or less maintain in 10 years time. And if that's what I'm doing, it's probably a great investment. How else is it trading at these levels? I'd be keen for your guys' interpretation.
Yeah, I reckon it's trading like a bank account almost, like once you frank up that yield. So I think supporting what you say, the yield sort of roughly matches what you get in a bank account.
And the share price will protect me from inflation a bit.
I think it covers both scenarios too. That's probably the double whammy because it's also a recession scenario, right? Like everyone still needs to do their shopping. It's probably the most defensive, one of the most defensive businesses in a recession. So yeah, it could be a bit of both. Like people buying it because it does okay and inflation does okay in recession, and that's like enough. But man, you got to think if you're buying that with that view, there's definitely a path where that multiple comes down a lot, like
it's hard to beat actual just cash, right? That's the thing.
Yeah, at a certain point. Plus, once Aldi starts doing online deliveries, man, I know where our family shopping's going to go.
Yeah, true. I'm an absolute sucker for Woolworths online deliveries.
Maybe to tie off the Druck point on inflation, he sees a very wide range. So he said it could go back up to 8% or -2. Like he sees deflation in the scenario with the hard landing, which he's very big on the hard landing. So I guess the other argument is if we have a recession later this year, inflation dies in a recession potentially. I mean, it does typically die pretty quick in a recession. And we could have stagflation, but that could be a scenario where you want to have cash. You buy things a lot cheaper in a recession, but you don't have to worry about like the slow bleed out from inflation.
Yeah, that's my kind of default thing.
Timing.
Like, just if things do get worse, it'll be a massive win for me. But then, what's the downside of it? Like, what happens if it just, it's all good and you've just been sitting in cash this whole time? That's your risk.
Oh, sorry, Claude, jump in, but I found myself that I need to reconcile, I need to square a certain circle here because I find myself when talking about trying to protect against inflation and recession and that kind of stuff, I go towards that strong balance sheet, reliable cash flows, pricing power. But then I look at my portfolio and go, if I'm being honest, like a lot of that doesn't ring true in terms of what I'm holding. And am I being inconsistent there? Or I mean, I guess I've got an answer, but I know that you guys are the same, right? There's a lot of early stage small cap companies that are there. So how do you hold those two very different thoughts in your head?
I personally don't have a strong view that inflation is going to continue for a long time. So that's not like my base case,
Okay.
at least at the rates that it has been. Like I'd see it already coming down to around 4-ish% on like the core thing. So I'm not saying it won't. That's not a strong view for me at least.
Okay.
Yeah. So that's probably part of it. And I guess your portfolio, you still have a lot in an asset that we won't need to get into. That is, I'm sure your view is inflation related. So if you think of your whole portfolio, it's probably you are pegging that way more than you might think.
Yeah, it's the same as us in a way. Like I have still some of those, earlier stage growth companies, but just way less than I used to. And it's a bit of a pain trade at the moment. But, if and when the interest rates, even though I'm probably more thinking inflation's more sticky than you think, Matt, I'm not that far off you in terms of where I think that you've got to also prepare for the time when it finally comes down and, the bountiful fields of growth investing start.
Money supply is contracting, I guess. That the stuff that I look at, money supply is contracting. We're rolling off all of the goods inflation, and then we've just got services to watch and to deal with. And
for sure.
That's ticking along. But
well, I just get my rationalization would be you spoke before with Soros on the 30% success rate. I guess you've got to know thyself and know what you're trying to do here. And I think the maths that you're relying on here with this kind of investing is that you actually expect quite a few to not pan out very well, but when those that do, this significant upside makes the whole exercise worthwhile. So I guess, I don't know, let me know if you think I'm being intellectually inconsistent there and if that doesn't make sense, but I guess that's how I would sort of rationalize it in the sense that they're not all classically super defensive, hyper robust sort of businesses for the long term, but the growth potential is so substantial for some of them, even though most of them won't live up to their expectation. Those that do will carry the load. That was the story for a very big chunk of the last 10 years with Pro Medicus and others. Are just a couple of them and this is people will have heard of the rule of 5, right? For every 5 investments you hold, 1 underperforms massively, 3 kind of does what the market does, and then 1 just goes to the moon. That's how I'm expecting things to sort of go out.
Yeah, I think that's reasonable. And like with small caps, the company specific developments can override macro pretty easily.
Yeah. I mean, what does it matter if inflation, if your per share earnings are growing at 20% for 5 years, anyway, sorry.
Speaking of small caps, we're going to talk about a little bit of a sector today in the telecommunications sector, which is one we haven't, I don't think, talked about at all really on the show. And I wanted to introduce for discussion, I don't own any of these, but I wanted to introduce a few small cap telcos that might be worth a look. Now, the thinking here is essentially, I'm not saying this is ironclad reasoning, but basically telecommunications companies do tend to have some physical real world assets, which they have built and paid for over the last XYZ many years. But potentially in an inflationary environment, wages are going up, materials are going up, everything's going up. Literally just the cost to replicate those networks goes up over time. So whereas their accounts will, of course, show the depreciation of these networks, the value of them may not be going down that quickly. Now, that depends on the type of equipment, depends on the network, but the sort of general rule of thumb is that you don't necessarily need to replace the fiber optic cables after 25 years. Like, just because they're now written down to $0 doesn't mean they stopped working. The same with, some maybe wireless equipment or whatever. It might depreciate over 5 years, but it still works after 6. So there could be some hidden value in those kind of companies. And the three that I was going to talk about were, first of all, Superloop, SLC. Now, this I think you have to classify it as a bit of a dog. I'm not sure if you guys have followed it much, but I reckon, Andrew, you should definitely try and get them on Straw Man sometime, because ultimately it could be a bit of an interesting turnaround story. Now, of course, as
is this a Slattery investment?
Yeah, I'm not sure how involved he is these days. I think it is. I think I recall. Yeah, no, it definitely was. It was definitely a Bevan Slattery show for a while there. But I think he may have at some point sold down a fair bit, and the company kind of went in, did a divestment and bought, I think it's Exitel from memory, and putting that on their network. So they're going through what I would say is a little bit of somewhat of a strategy change to become more like just any kind of normal broadband telco, even though they also have like a significant wholesale division. And I guess in a quick pitch, why should you look at it? Why should it go on your watch list? You do have directors buying shares. You have, I would say, maybe like a potential argument that the book value's interesting. Not that it's profitable at this stage, but what we do have is you have, mostly due to acquisition, this sort of, it's getting scale and potentially heading towards profitability as well. In the best case scenario, this kind of business, the wholesaling, the consumer probably won't do that. They have ambitions to grow it, I think, to double subscriber numbers in 3 years. No real guarantees that'll happen. And consumer is obviously at least somewhat competitive. There's a business segment as well that could be a little bit interesting, because generally speaking, if you have a relationship with a certain business and that business is growing, then its need for internet over time also grows. So there's that, and there's also the wholesale, which is the ultimate kind of, you can just start tapping into economic growth. So for that reason, could be interesting. Yeah, open up to you guys. For me, it's definitely too early. I'd like to see it actually become, or at least see the next set of results. But one that could be a turnaround story, I reckon.
My issue more broadly with a lot of these companies is it's really hard to identify their competitive edge. It feels very like a commodity product. Like I know some networks are better than others. I know that they're definitely not worth nothing. They're definitely very valuable kind of assets, but most people just want connect me so I can make some phone calls and browse the web. Who's the cheapest? That is generally what most people will do. And it strikes me as something that, I think you're right, it'll be a very resilient area. I mean, it's the last thing I'm going to cut back on is that kind of service. But I feel as though that pricing power is, they tend to run at pretty ordinary margins, right?
Yeah, definitely. So, but that point leads me right into the next one perfectly, though. So I agree that I don't think Exitel or MyRepublic or anything are particularly strong brands there, but I think one brand in the space, which is a listed company that arguably has some brand value, which can give some modicum of competitive advantage, would be Aussie Broadband, which I'm sure you guys have heard about. It just seemed to make a bit of a splash in terms of, I've heard many times people say, oh, they're easy to deal with, or they have good internet speeds and that kind of thing. And you could argue they're trying to do the old iiNet playbook, where you just have a slightly better telco that that give slightly better customer service and competitive prices. And then you gradually don't have to be so competitive in price because you have a good reputation, basically. And I have to say, we have occasional internet problems, and every time I'm like, oh, we should change, it would be Aussie Broadband that I would try, because, I'm on one of the legacy ones, and it's how sticky it is. And so I've heard good enough about it. And on top of that, with Aussie Broadband, you would actually have to say that the financials looking significantly better than Superloop's. I was looking at it, they have had strong growth in the last half, albeit off a pretty weak prior corresponding period, and they're forecast to have a stronger second half this year, which they basically always have, or for the last few years have had a stronger second half, so not too hard to believe there either. And yeah, it's probably expensive multiple, but if analyst estimates are correct, it's probably around, I think, mid-20s in terms of PE ratio, based on consensus analyst estimates of about 14 cents per share that I'm looking at the moment. So overall, this would be my favorite telco small cap, just on the basis that you could argue its growth at a reasonable price. Obviously, I'm not saying this one's like an asset play in the same way Superloop is. It would be more, the pitch would be, hey, this is a telco that has a pretty good brand, and that's going to give it a good situation. And it's also, it's also getting acquisitive growth as well that always seems to be rolled up in telco land, and they did attempt they did propose and then succeed in acquiring over the wire, which should give it a little bit of acquisitive growth as well.
Yeah, I mean, I think Aussie Broadband, there is something to that. I've used them and found the customer service was a lot better. They've also positioned themselves as like a premium player.
It's hard to be worse though, isn't it, with the big one?
Yeah, well, they answer the phone
eventually. Yeah.
No, that's what I'm saying. Aussie Broadband do is that's like the high level of service.
When I had to cancel a TPG contract once, the only way I could figure out to do it eventually was to call up the sales, who would actually answer the phone, and then just be like, I'm just going to stay on the phone until you find someone that'll cancel for me. And that finally worked, because they have some rule that they can't hang up on you or whatever. So you say, please don't hang up on me. Just please let me cancel my thing.
How annoying is it when you have to call someone to cancel a subscription service? Like, there's so many things doing that, like newspapers and stuff doing it now. It's just infuriating. It should be illegal, I think, frankly.
All right. And the other thing you do is, whilst you're on hold, you say, while I'm on hold, I'll be filing a complaint with the ombudsman.
Yeah. That's a good magic word to get.
That's how you cancel.
Bumped up a bit. Yeah, so I think that there's something to that, basically. I guess the multiples had been pretty high for Aussie Broadband, but yeah, you're right, they're coming back down. No, I don't have too much against that thesis, I guess. It should do okay. I guess you could argue, like, in a recession, maybe some of their customers cut back from those high-speed plans and go, actually, do we need to be paying $100 a month when we could pay $80? So maybe Aussie Broadband's a bit more exposed to that, the flip side of their premium focus that's helped them have higher margins. But I mean, overall, this isn't a business that, at least on the customer demand side, is going to go away, or, people are still going to pay their broadband subscriptions. That's like, it's almost like water or electricity now, right?
It's a basic utility. Yeah, 100%.
Yeah, and the other thing is that I feel like the price has come down a little bit since the founder announced he was going to sell shares. And obviously, we never love to see that. But at the same time, it was like 3% of his entire holding. And it makes it much more plausible that, it's actually not de-risking. He's not de-risking his exposure. He just needs a bit of cash flow, so, as they say, for tax reasons, which is the classic one.
Yeah, I think one other, I guess, kind of general concern with broadband over time is if we're fully penetrated and more people start kind of cutting the cord and just using their mobile phones, like younger people that don't have a broadband subscription ever, could be more of an issue. But again, these are all things that I think are pretty able to see in advance. You didn't mention this type of business, but there's another one they looked at, Field Services, which is more like rural internet. I'd looked into that quite a bit, and at the time, it was basically Starlink was like a big part of why I didn't pull the trigger. It was just like, how good is Starlink getting? I just thought it was worth mentioning. I just saw an article, I think it was just this week. Starlink is already at 120,000 Australian customers, and that's up 20,000 from February, so just in the last 3 months. So it's growing extremely fast. It's not an issue for like Aussie Broadband. It's more for like rural users. But yeah, just an interesting dynamic in all this. So you've got the internet from space, which is just not something that would have been foreseen at all. I mean, it was being delivered internet from space via, medium and high Earth orbit, but it's just a very different quality of service, cost, etc. So yeah, just how technological change can still come to these areas you don't expect them to.
Well, that looks like that was a good avoid, Matt, on field services.
Yeah, I don't know if it's related just to the Starlink thing, that longer term thesis I had, but yeah, so far it seems it might have some other company specific strife that it's been facing.
Yeah. Well, right for the wrong reasons, still right, mate.
Yeah, take it.
No, great stuff. Yeah, so actually, it's a really important and interesting thing to raise those. You never know the impact Starlink could have in another 10 years. Maybe it could start having an impact on wired broadband. Obviously, even with the low Earth orbit, it's not quite as responsive, but yeah, I think Starlink is a wonderful bull case for eventually a lot of regional towns and regional areas starting to get a bit more population growth as well. Anyhow, the last one that I thought we could talk about, which is one I think that we have touched on more over the years, and one that I used to own for a long time, called Symbio, and that's divested its sort of consumer internet stuff now and is basically focused on being a wholesale provider, particularly of say like voice connectivity, so number porting and that kind of thing that allows you to use Skype to call a mobile phone and that
this is
kind of thing.
Formerly my net phone for anyone who's followed for a while.
Yeah, exactly. And that did look. It just really sort of fell off the bike for a while and has presented some very weak results in the first half, just really bad. And it has to do with the bits that they have divested were like quite profitable, so they lost profit from that, and at the same time they have been investing in expanding geographically into Malaysia, Singapore, and Taiwan. So just a bit of a transition period for them where they're sort of investing in future growth. And they are forecasting a stronger second half. They recently came out and with an update called Trading Update Confirms Guidance, in which they decided to confirm its FY23 EBITDA guidance in the range of 26 to 28 million, which is was super. I think it just gave me a bit of an ick because I'm not sure if that was the previous guidance. I remember there being a different number, so I think that there's some moving targets there. I'm not so sure that that's as good as it seems, essentially. So ultimately, it is in a bit of a downgrade cycle. They've had a few misses, but it looks like, it's stabilizing, and the second half will be stronger even with this reconfirmed guidance. So a turnaround story in the making, perhaps.
I have spoken with Rene before, like way back in the day. He did strike me as, I liked him a lot. He seemed really long-term focused, shareholder friendly, big skin in the game, understands the technology, the industry pretty well. I mean, I don't own shares. I'm not trying to shill for it, but I remember, I thought he ticked a few boxes as a leader and founder.
Yeah, I need to get a good picture of whether they finished this sort of downgrade cycle, because they really just did have a series of misses in terms of where they thought they'd be and where they came in. And that's why you've seen this massive share price collapse from, above $6 to down below $2 now over the last couple of years. And it's even above $7 actually at the peak. So I think it'd be great to see if they got even like an upgrade one time or beat their guidance or something like that. I think that'd be a strong sign for me that things are back on track there. And if so, generally speaking, I think that they're smart operators. They're like reasonably aligned and they will do their best. And the reason that they're taking the pain now is because they like have a plan and a vision of where they want to go to and the niche they want to exist in Southeast Asia and Australia more generally. So yeah, I quite like this and I wouldn't be surprised if I buy shares in it sometime in the future. But again, I think a lot of people, myself included, are a little bit nervous about the guidance misses and stuff. And it generally does kind of it's harder to have confidence in management when they come in below expectations.
Yeah, makes sense. Should we wrap up, gents? We talked about the debt ceiling a little. We didn't cover. Did you have any thoughts, any picks on what's going to happen? I thought Druck kind of mentioned it as everyone's worried about a 30-foot wave when they should be worried about the 200-foot tsunami coming in a couple of years.
So he's not worried about the debt ceiling.
He's not worried about the debt ceiling short term, basically, thinking they'll raise it. I saw some other takes that it's not really an issue for right now, that we'll probably get through for June, and then the next issue will be in like September or something, which I just thought was another fine point on it. But I don't know. I guess my take is they do just end up raising it just like every other time.
They will, because the alternative is so dramatic. I mean, it literally undermines the trust in the biggest financial network in the world. And it's just like the cost of borrowing for the US will skyrocket if they have a hard default. So they will. But what's interesting about it, though, is that these days, in past debt ceiling crises, I think there have been more mature, cooler heads at the table. Politics has gotten increasingly partisan. There's some pretty strong ideologues on both sides of the aisle, particularly in some some of the Republicans that are out there. I was like, wouldn't mind seeing the world burn if it helps achieve their own agenda. It's sort of, so I think they will, because like the alternative is just so difficult to imagine. Could you imagine the US not paying a coupon on its debt?
I actually heard one take that if they didn't raise it, they would just cut all discretionary services spending such that they wouldn't be in deficit. So it wouldn't be, they're making the argument, it wouldn't be a default, it'd just be like a very big fiscal drag. There'd be less government spending basically.
There would literally be riots in the street. I mean, I don't think that's too much. I mean, look what happened on January 6th.
I mean, they already have riots in the streets.
I was thinking, do I want to take the other side? Because I don't think it would cause a riot, but I definitely don't want to bet against riots in the street.
Oh, there's just generally like anything can cause a riot. Like the wrong school book in a private.
If it went on long enough, it would cause a riot. I think you basically suspend, like you'd stop all schools, you'd keep police, you'd keep defense, and like a few other things.
I mean, what politician getting up there and say our ex-servicemen and women were not going to pay your entitlements? I mean, from an American lens like that, it's inconceivable. It's inconceivable.
Yeah. Well, anyway, so I have one question regarding the debt ceiling, and I'm glad we talked about it. I definitely stole this take from somebody, so I apologize. But is it the case that basically the politicians are going to keep prevaricating until the markets start freaking out, and it's just like the market's like, yeah, you guys will sort it out, we don't care. And then the politicians are like, well, if the markets are fine, then we'll continue to play chicken and make it, freaky until the market does freak out, at which point they're like, oh yeah, okay, now there's a bit of chaos going on, so now we'll settle things down.
I think there's a very strong case for that. I think that's basically what happened in COVID. Look at what happened in COVID. Like we were like, we were tracking it earlier, right, Claude? Like in February, we were like, what the hell? Why isn't people reacting? And it just took until the market started freaking out, and then everything responded. Like it's bizarre.
Yeah.
But yeah, I think that's where a lot of our I agree. I think that there's a strong case to be made for that view that volatility will spike up enough that it causes everyone to actually solve the problem.
Yeah, if we get a bit of panic, then that'll be a buy the dip moment, right? But when everybody's thinking that, you don't get the panic. You need to get enough people genuinely scared, and then you get the panic. And the crash only happens once all the legions of people being like, buy the dip, have like hit pause for a moment because they are worried.
I'd say it doesn't need to be like a huge, like it's not going to be like, it doesn't need to be a stock market crash, for instance. It could just be like March, like 2011 when they last raised it. There was a lot of panic and blah, blah, blah. At the time, it felt like a big deal, but we've had bigger deals since. But yeah, no, I think that's fair. Should we close it there?
Yeah, good to chat, guys.
I'm sure plenty of stuff to talk about next week. I'm sure the debt ceiling won't go away. We could run this topic every week if we wanted to, I'm sure.
That sounds fun.
Yeah. Cool. Good to chat, guys.
Thanks
for listening, everybody. Have a nice day.